Welcome to This Explainer. I am so thrilled to have you here today. We are completely demystifying the whole concept of wealth building. We often think of wealth as something totally out of reach, something reserved for lottery winners or tech billionaires. But the actual data, it tells an entirely different, much more accessible story. Today, we're going to unpack a really effective framework I like to call time, assets, and action. By looking directly at the numbers and historical data, we're going to see exactly how wealth is systematically built and, just as importantly, protected. All right, here's our roadmap for today. 1. The power of compounding. 2. Assets of the wealthy. 3. Real estate, the great divide. 4. Commercial versus residential. And finally, 5. Building your wealth plan. Let's get into it.
Okay, let's dive into this. Section 1. The power of compounding, your fundamental mathematical advantage. We live in a world of instant gratification, right? But when it comes to wealth, your time horizon is literally your biggest advantage. Just think about the stock market for a second. On any given day, the S&P 500 is positive about 53% of the time. That is basically a coin toss. It is so easy to get anxious if you're only looking at the short term. But here's what the data from Cetera Financial Group shows us. If you just extend that time horizon out to 10 years, the historical probability of a positive outcome jumps to a massive 94%. And over 16-year rolling periods, it has historically been positive 100% of the time. Time effectively neutralizes all that short-term market noise.
Now let's put some hard numbers to this whole concept of time. $3.18 million. This is just a staggering mathematical reality from the Cetera report. If you start investing just $500 a month at age 25 and you let that compound with a 10% average annual return, by the time you hit 65, your portfolio will have grown to nearly $3.19 million. It's the snowball effect. In action, your returns generate returns, and then those returns generate even more returns. It's beautiful. But hold on, contrast that massive number with this one, $668,945. This is the exact same $500 monthly investment, earning the exact same 10% average annual return, ending at the exact same age of 65. The only difference here? This investor waited until age 40 to start. Delaying your start by 15 years literally costs you over $2.5 million in potential wealth. As the data clearly shows, time in the market often matters way more than your actual rate of return.
Of course, getting those compounding returns means you actually have to stay seated on the ride. This roller coaster analogy is perfect for contextualizing market volatility. You just can't get long-term gains without some short-term setbacks. Since 1980, the S&P 500 has experienced an average intra-year drop of 14.1%. I mean, let that sink in. On average, the market drops 14% at some point every single year. Yet, despite those incredibly scary drops, the market still posted positive annual returns in 37 of the last 45 years. You absolutely have to endure the dips if you want to capture the growth. Moving right it along, Section 2, Assets of the Wealthy, what the 1% owns. So when we look at the assets high net worth individuals nearly always own, notice how they balance tangible assets, income generators, and long-term growth. We're talking high-value primary residences, precious metals, fine art, and privately owned businesses. But I really want to highlight two foundational pillars here. First up, stocks and bonds. According to Gallup, 87% of households earning over $100,000 own stocks. Second, rental real estate. Data from Redfin shows the top 1% of Americans own a striking 13.4% of all U.S. real estate. And finally, check out that last bullet, cash reserves. The wealthy intentionally keep cash on hand so they can act fast when opportunities, like a sudden market dip or a distressed property, pop up. The absolutely crucial point here is understanding how to diversify, which brings us to one of the more jargon-heavy assets on that list, private equity. So what is it? Well, unlike buying public stocks on an exchange, this involves directly investing in private companies, maybe a startup or a niche venture. It typically requires a much higher initial investment threshold, and your money is usually locked up for a longer period. But for the wealthy, it offers serious upside potential and a really unique layer of diversification completely outside the public stock market. Section 3. Real estate. The Great Divide. Real estate is a cornerstone asset for building wealth for sure, but it is definitely not a one-size-fits-all venture. According to Investopedia, investors generally face a choice between two very distinct paths. On one side, you have commercial real estate. This involves business purposes. Think offices, retail spaces, warehouses, and big apartment buildings with 5 or more units. It offers higher rental yields, but it's highly complex.
On the other side, residential real estate focuses on living spaces, single-family homes or small buildings up to 4 units. It's way more accessible, requires lower initial capital, and provides steady, albeit usually lower income. They cater to completely different investor profiles and capital capabilities.
Let's move to and see how this bills. Section 4. Commercial versus residential. A granular look.
Let's break down the risks and rewards here systematically. With commercial properties, you're looking at higher average returns because you have longer leases and can generally charge businesses more. But the initial investment is much higher, and crucially, the market sensitivity is higher. If the economy takes a downturn, businesses cut costs or close up shop. Residential real estate, however, kind of flips the script. Your yields are lower, and you're dealing with higher tenant turnover because residential leases are shorter. However, your initial investment is much lower, and it is far less sensitive to economic cycles. Why? Because even during a recession, people always need a place to live. Residential delivers lower risk and much more stable occupancies overall.
Now, if you do venture into the commercial real estate world, you have to understand net lease structures. These basically dictate who pays the property expenses. In a single net lease, the tenant pays property taxes plus rent. Double net adds insurance to the tenant's bill. But the absolute gold standard for landlords, that's the triple net lease. Here, the tenant pays taxes, insurance, maintenance, and rent. This shifts almost all the variable expenses to the tenant, giving the landlord highly predictable cash flow. The trade-off, though, is that this heavy financial burden can make the property less attractive to potential tenants, which obviously increases your vacancy risk.
Which brings us to our final segment, Section 5, Building Your Wealth Plan Actionable Steps.
We've covered a lot of ground today. Everything from the math of compounding to commercial leases. To bring it all together, I just love this quote from Benjamin Franklin, which was actually highlighted in the Cetera report. Money makes money, and the money that makes money makes money. I mean, it is just the most succinct, brilliant summary of compounding returns ever written. Your goal isn't just to work for your money. Your goal is to get your money working for you, and then let those earnings work for you too. And the best part, you absolutely do not need to be a millionaire today to start acting like one. Based on the insights from our source material, here are 3 smart moves you can make on literally any budget right now. Step 1, pay down high-interest debt. Freeing up your cash flow is the ultimate prerequisite to wealth building. Step 2, explore side income opportunities. Creating even a small secondary income stream gives you the breathing room to actually invest. And Step 3, start investing, however small. A diversified portfolio grows with time, not perfection. Whether it's stocks, a small residential property, or just putting a little cash into an index fund every month, getting started is the hardest but absolutely most important part. We've seen today that time is the ultimate multiplier. We've seen that the wealthy focus intensely on owning income-generating assets, and that options like residential real estate offer really accessible entry points into lasting wealth. The math is clear, the strategies are proven, and the clock is ticking. So keeping everything we've looked at today in mind, I want to leave you with this one vital question. What will your next financial move be? Take a hard look at your finances this week and take that first step. Thank you so much for joining me for this explainer, and